one of the interesting ones that I got. So we put out a thing on Instagram. Thanks everyone who gave us questions on Instagram. One of the interesting ones was Michael Burry and someone wanted to talk about his prediction that index funds are in some kind of bubble.
Right. So what's the thinking with this? Is the thinking that because everyday investors have been so switched on over the last, say, 10 years to this concept of ETFs, because actually ETFs haven't been around for too long. They've only been around for like 15, 20 years as a concept. So is the idea that over time people have realized that the markets go up over time and ETFs are such a simple way to get into the markets diversified that just like a crap load of money has been funneled into them, so much so that they're like artificially inflating the prices of companies underlying? Like, what do you know more about what he's thinking?
So like, if we go back to the housing bubble back in 2008, and if you go watch The Big Short, it's a fantastic explanation of what's happened there. But basically, people felt as though housing was so solid, it had always gone up, and the returns were starting to get very high to the point where people thought there was no way they could lose money. That it was a win-win situation.
Yeah.
And there was no way they could lose. And Michael Burry sees the same thing in index funds. And I definitely appreciate the perspective, because there's a lot of people in finance, us included, guilty of this, of just saying that index funds historically go up at 6 to 10%.
Yeah.
So it's the safest way to invest. And there could be this thing where a lot of people are just buying index funds because they think that return is certain.
Yeah.
When you're buying the index, you're basically buying a bunch of stocks without considering their actual underlying profits.
Yeah.
So
true.
It's
I would say most people buying index funds, they don't even look at all. They don't even consider what companies are even in them for the most part.
Yeah.
They just trust in something like the S&P 500 or the ASX 200 or something.
Yeah. And I encourage people to go out and find what Michael Burry has said in detail about this, because it goes a lot deeper than what I just explained. It goes a lot deeper than that. There's a lot of intricacies in relation to derivatives and how index funds are formed and what happens when people buy and sell index funds.
Right.
That is adding to this bubble effect that Burry thinks. But yeah, it's certainly interesting. Whenever you have something like that where people are investing because it's going up and they're not considering the actual value of what's happening, it's the same thing as what happened with Bitcoin. People were just seeing it go up and they thought that it was a certainty that this was where the future of currency was going to go now.
Yeah.
And people were just buying into it. You had people who had no business investing in the stock market. You had people in high school who just wanted to gamble on it and just assumed that they were going to make a lot of money. And they all got burned really badly,
basically.
Except for maybe a few people who were lucky enough to time the market and get out near the top.
Right, okay. What do you reckon?
I can see it. I mean, the thing with bubbles is that it's so hard. Like, you can see it forming, but you don't know when it's going to pop. I mean, I was saying for a long time that Bitcoin was a bubble, and I think everyone saw it, but no one knew when the cascade was going to topple. And it was the same thing with the housing bubble. I mean, people were calling for that for years. People were saying that this is a bubble. There's a lot of really poor loans, really bad, dodgy loans that are going out to people who don't have income. But for a long time, it just continued to churn on. Yeah. And it continued to go up. So with these kinds of things, I like to observe them, but that's about it. Like, I like to have a look.
Don't buy into it.
But I'm not going to be, I don't really take a position either way. I just like to see what happens.
Yeah. We just stick to our strategy instead. Don't mess around with things that are overhyped or potential bubbles or anything like that.
Yeah.
Just watch it. Learn from it, I guess.
Yeah, and it doesn't really affect me for the most part. I have a little bit of money in an index fund, but for the most part, my money's in individual businesses where I've done the thorough analysis to work out what conservatively am I going to get out of this. And therefore, I know that the price that I've paid is going to give me a satisfactory return.
Yeah.
And if you do that kind of analysis, then you protect yourself from bubbles. Yeah. You take Bitcoin, for example. If I wanted to look at it and it was going up a lot and I wanted to see if it was a good investment, I have to compare what am I going to get back from it to what I'm paying. And can I can I objectively measure what I'm going to get out of Bitcoin? And you couldn't. You could not measure what you're going to get out of it. Therefore, you couldn't invest in it. And just having that simple philosophy protects you from about 99% of bad investments.
Pretty much. You're not wrong. Yeah, if you're a Bitcoin investor and somebody literally seriously asked you, where's your investment likely going to be in 5 to 10 years?
Give me a ballpark.
Yeah.
Give me a conservative estimate of where it's going to be. And there's no way to
explain
measure it.
and explain why.
And explain why.
Then people would be, they'd probably say, oh, Bitcoin's going to be at $1 million.
Yeah.
Why?
And no one here, we're not saying that these things can't go up. We're not betting against them. I think that's something that people get wrong with what we talk about sometimes. We're not betting that it's going to go down. We're just saying it's too uncertain.
Yeah.
To put our money in it.
Pretty much, yeah.
Rule number 1.
Yeah.
Don't lose money. So don't invest in anything that's going to that's very uncertain. Invest in things that are close to certain.
Yeah.
And
pretty much. And those, I think the problem is that humans think very short term. Very short term. I think it's just wired into us.
Yeah.
So people feel as though it's fear of missing out.
Yeah.
If you're in a high market, even a lot of people that follow my channel, or probably your channel as well, have felt the fear of missing out and have bought into this market, even though from all kind of things that we look at, most would agree that the market's probably pretty damn high, overvalued. And I think the thing to realize is that when stock markets move, they don't move over, say, like 1 or 2 years. Well, of course, they move over 1 or 2 years, but really the trends that you see are more like 5, 10 years. So even now I'm seeing people that have bought into this overvalued market on the fear of missing out, when really Buffett and everyone says that these great opportunities, like the really good opportunities where what Phil Town says, you want to load up the truck and just like buy, like everything you can. They happen so incredibly infrequently.
Yeah, and one thing that I find really fascinating is, as humans, we kind of think where our memory is better than it actually is. Our memory is so much stronger in the short term than it is long term. Like the longer term you look out, the weaker your memory is.
Yeah.
And then we like to think, and the result of that is really we weigh short term events so much heavier than things that have happened in the past. I mean, you think about the financial crisis. It was 10 years ago or so, 11 years ago. And people have a lot of people have forgotten.
Yeah,
that's
markets
happened.
have recovered.
I don't know.
Plus some.
I don't know if this is just a thing I'm sure it's not a thing on my channel, but there's a lot of people saying we can't have a crash anymore.
Yeah,
and
potentially.
It's amazing because people warned, like when you watch footage about the 2008 crash, there's people saying the same thing, and I was like, there's no way anyone's stupid enough to think that like there couldn't ever be another crash.
Yeah.
But you see the comments, like people really do forget, and it's amazing how short term people really think.
It's only 10 years ago, 11 years ago. Yeah, it's pretty nuts. And you're right, it's so short term. At the time, everyone's like, seems like the sun's not going to rise tomorrow kind of thing, but of course it does. And you give it 10 years and look at where we are in the markets now compared to where we were in the depths of 2008. It wasn't it? Yeah. 2008, 2009.
There's some horrible things that have happened globally that you would have thought in the midst of that the world is ending. I mean, multiple world wars, many trade wars, many cold wars, conflicts between different countries.
Yeah.
The production just continues to increase. Spending continues to increase. Innovation continues to increase. And businesses make more money.